Markets to the upside big time today. Not quite a 180 from yesterday's panic global sell-off, but pretty close. Investors might have been caught off guard yesterday, but Bob Wiedemer says he saw this coming. Hey, Bob, prove it.
Well, I can't say I can prove it exactly. I would say I expected this to really come Sunday. Yeah, you had 3 big down days in a row. I'm not at all surprised we get a rebound, but one-day rebound doesn't really change a trend. This trend's been down. I think that trend will continue even if the trade today was up a bit.
How did you see this coming, though?
Yeah, well, I think it'd be hard to say that. Well, I saw the downturn coming because I think without money printing, this market's going to go down 20% before the Fed comes back in, pumps it back up. This rebound, it's not unexpected. We see some sort of rebound along the way. Markets don't go straight down. And, certainly it could be a while before we hit 20% and the Fed has to come in. But I do think the Fed will come in and pump it back up.
But why? Why? I raised this question in the last block with my last guest. Why does the Fed feel compelled to just rescue financial markets?
It's a great question, but I'd say because they've kind of gotten into it. It is like heroin. Once you're on it, it's hard to get off. As the last guest was talking about, it's very, very difficult to get off the medicine. And I think the Fed is now committed and has committed itself to basically maintaining these markets well above what's going to be a long-term market equilibrium. So if the market goes down, it can set off a financial panic. If it goes down 30–40%, I think the Fed's going to definitely feel compelled to get back in with money printing.
I mean, people point to this downdraft in commodities as evidence that there is deflation out there. What if it's just the popping of a bubble that was inflated in the first place by the ocean of cheap money around the globe? That's the thing I don't understand. And I also don't get that a quarter-point hike and then a stay would be disaster for the U.S. economy and the stock market.
Yeah, exactly. It used to be a quarter point was nothing, and we would do that periodically and no big deal. It's not a disaster for the stock market. The stock market is fragile. Commodities have been going down for a while. That's nothing new. China's been a problem since June. All this downturn in the markets just in the last basically couple of weeks. I think, again, it's just a market that doesn't have a lot of buyers in it, and when the buyers walk away and aren't too interested, it's very vulnerable. And there's no Fed out there, helping to juice the market. Stock buybacks are really the other big buyer. They're not going up, not necessarily going down, but it's vulnerable to a decline. And you're absolutely right. It's a lot of other things are changing, like commodities, but I don't think that that's what's necessarily popping the stock market bubble right now. It might be making people worried about China, but China's only one element affecting our economy. And I think it's just people are nervous. It's a faith-based stock market, and people are kind of losing faith.
And Janet Yellen better stock up on some aspirin because she's going to be a target by these presidential candidates in the coming months.
Yep.
Thank you so much, Bob. Good to see you.
Thank you, Dagan.